Brilliant. Thank you. Welcome to today's webinar where we'll be looking at day trading, the indices, and we're looking at current commodities as well. We're not just we're just looking at indices today using volume price analysis and the quantum tools. But before we start, as usual, can I just draw your attention to the disclaimer, which is up on the screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Here we are, myself and David. We're not here. That photograph was taken at one of our other trading stations, as it were, where somewhere different, and it's been a sort of a funny old day today, isn't it? Quite cold, a bit sunny, but anyway. This is the third of our webinars. I think some of you have been with us all day, which is fantastic. Thank you so much for sticking with us, and let's see what the markets are going to bring today. And as always, we'll be looking at the charts through, as I said, the prism of volume price analysis, which is the technical analysis approach that David and I have been using for the last almost 20 years now. But obviously, individual markets don't move in isolation. They don't move in their own universe, as it were. They're all interconnected. We have the Forex, equities, bonds, and commodities. So whatever is happening in one, you're going to get a reaction. You're going to see something that is happening somewhere else. And as a trader, it doesn't matter what you trade, whether it's Forex, whether it's indices, you really do have to be aware of what's going on in the bond market, sometimes the commodity market, but certainly the Forex market, regardless of what you trade, because the Forex market is where sentiment is reflected the quickest and the fastest. As I said, we use the Ninja Trader indicators. This is from quantum trading, which is where you'll find details of all the indicators. Now, before we do, having said all that, just take this away. I've actually got a chart here, which is the 4-minute chart of the Euro Aussie, and I've got it up for a particular reason. Not because we're looking at Euro Aussie, it's because I had a question from someone posted on my Facebook page about congestion phases, given that we know that markets stay in congestion an awful lot longer than they trend. How do you know what kind of congestion are you looking at? Are you looking at a congestion whereby there is price agreement, there's fair value based on the the principles of market profile, or are you looking at a distribution phase or an accumulation phase? And how can VPA help you identify that? VPA can also help you identify whether a pullback, a minor correction in a primary trend, is that going to be a full-blown reversal from primary to primary, or is it simply that, just a pullback before the price moves higher? And I've got this 4-minute chart because it's from the Euro Aussie, and it actually has an example of everything that I want to say. Sorry again about that. The same person came back to the door, so having told them that we were busy, so I do apologise. Okay, this is a really nice chart, and the Euro Aussie. The other thing to bear in mind with congestion phases in 24-hour markets, and 24-hour markets we get on Globex for the indices, and obviously in Forex we get 24-hour markets as well. So you have different sessions. Each session has different levels of participation and liquidity. This doesn't actually go far back as to the Asian session, but looking at congestion phases, and we can see this congestion phase here, where basically the price is oscillating, and it's oscillating around what we call the volume point of control. One of the ways we can identify whether we are in a congestion based on a tight range, simply because the market doesn't have a strong bias in one direction or another, and which is the reason why we developed the volume point of control, because here we have volume, price, and time. What that also does with volume, price, and time is that the longer an instrument or market stays generally within this rotating around the VPOC or contained within a range, is when it does break away, as we can see here, Wyckoff's second law comes into effect, which is cause and effect. So basically, the longer the cause, the greater the effect. And if you like, the identification of a congestion phase that is part of the second law, you're looking at a fair value, you look at a non-directionless market, as it were, not an accumulation or a distribution phase, is you have to use either the quantum volume point of control, or you can use the volume at price, and you can that doesn't come as standard on MetaQuotes, but it does come as standard on NinjaTrader. The problem is with the volume at price, it's a great standard indicator. You then have to look at the histogram. This is the histogram, which is part of the VPOC, and determine where the fulcrum of the price action is. This is the area that we're looking at, because somebody else asked me a question, volume and price, and said, well, why did the price break away from one region where you had the deepest volume, but didn't sort of reverse off another? And I said, well, you have to identify, as I said, the point of control, and this is what we call the volume point of control. So that's how you identify one type of congestion. Now, you could also, in the trend higher, this is a clean breakaway, lots of volume supporting the price higher, and then we have the first significant correction pullback, these two little down candles here, with wicks to the top and a reasonable amount of volume underneath it. But what you also have to look with VPA is you have to look at the size of the candle relative to the volume underneath. So although you have two bars, two red candles going down with a reasonable amount of volume, look at the spread of the candle. That is telling you there is price support in this correction. Now, sometimes in some primary trends higher, you will get a whole series of these. You may get 2, 3, 4, and it could be even a tradable correction on an even faster time frame. But the trend carries on higher. We then have a volatility candle in the primary trend with a lot of volume underneath it, and we get the classic reaction to volatility, a retrace to within the spread of the candle. Again, we have two down candles, very different size candles, but pretty much the same amount of the same volume underneath it. But because we have a volatility, what we have to wait is for a break either to the top or the bottom to see whether the primary trend is going to continue higher, or whether in fact we are seeing a full-blown reversal. We don't get a full-blown reversal. It doesn't even go down to test the low of that candle. It breaks higher on the once the high of the volatility candle is broken. But the candle that follows is a very widespread candle, but reasonably above average volume, but for the size of the candle, not enough volume. So that is hinting that possibly this move is running out of steam, as it were. And you often find that with volatility, you get this sort of final push higher, and it just, as I said, runs out of steam. Then you get this little collection of candles here. You would say that would almost be a hanging man, David. Hanging man candle here, which is also a potential sign of weakness of reversal. And then you get the candles, little down candles with, as I said, not a lot of volume. I accept that, but because you've had the hanging man with very high volume, you could be looking at, for the first time, a a minor distribution, if you like, in this trend higher. And in fact, the distribution does come because you get a lovely waterfall, you get falling prices, and this is what we're going to see, lots of rising volume until it comes back almost to test the volume point of control. And this is where it gets interesting, because we're back into this, what you could argue is the fair value area, the area where there wasn't strong bias in one direction or the other, and we get some congestion again with candles. The up candles here, you see the reasonable spread candles, but again, volume is not huge. It's not telling us that this, you know, it's not ready to fall further, but neither is it going higher. Why? Because it is in the area of it's a congestion phase characterized by the volume point of control, and it moves again. It moves sideways. There's another attempt to fall back. We do have rising volume, but if you like, the volume point of control acts as sort of cushion for it. The VPOC acts as its own support and resistance through the prism of volume. We've now seen in the last sort of few minutes the attempt to break away again from the volume point of control, and this is where we need to see, you need to see rising volume on a breakaway when you are in a congestion phase and price has been trading around the VPOC, and you will see this in all markets and in all time frames. Lots of volume coming in under here. There's a little bit of weakness on that candle, but there's a huge amount of volume underneath it as well, and it's above. This is my 200 MA here. This is the fractal adaptive indicator moving average that I use. And really, so the different kind of congestion phases, one based on the volume point of control, volume at price if you want to use, the congestion phase that you see at the top of distribution, and obviously I haven't got an accumulation one, but I'm sure David has on his charts over the other side. And I shall send this recording to the person who asked that question, and how VPA can help you identify these different types of congestion phase. And of course, within the congestion phase, you can have congestion with volatility or without volatility. You have trend with volatility and a trend without volatility. Anything else you want to add to that, David? No? Does that cover it? No? Fine. Shall we move over to you? If you've got any questions, obviously just drop them into the chat box and I'll happily answer them for you. Yes, and lots of volume. And where's that going? Support and resistance wise, well, you know, possibly back to retest where we had the initial sell-off up here. And I've used the 4-minute chart because we actually want to see this develop quite quickly.
Just changing screens over to the Ninja Trader side, which should be coming up any minute now. Hopefully you can see that. There we go. I'll just move the chat out of the way. There we go. Okay, I'm on the YM at the moment, so we're on the June contract, and I've got a very fast chart on the top left. I've got 15-second running here. I've got the 5-minute in the middle, 15-minute over on the right-hand side, down to the bottom, 30-minute, and we've got the Renko, and also the daily chart. Perhaps we just start with the daily. There we go. And this was yesterday's price action, and pretty much all of it was contained in the last sort of couple of hours for us. Sorry, Doug? Yeah.
They weren't dovish enough.
No, they weren't dovish enough. Only my personal opinion. I think the whole thing was a complete overreaction, but it's not for me to say. I might think it, but there we go. That's how the markets have reacted. But to be honest, if you've read the report, what was actually said or what was not said, it was very thin in all areas. Lots of sitting on the fence, which is where most of the Fed members sit anyway. Got more splinters in their backsides than you could shake a stick at, but there we go. And it's no great surprise, to be honest, to see a reaction higher at the moment, which is kind of what I was looking for anyway. Because when you get these days, and we get a lot of them on Brexit, and have had over the last 2 years at any rate, you get these ridiculous reactions. to a sudden piece of news. Someone says something and the market reacts violently. Great opportunity for market makers to step in and make money. But it is very much overdone. And as Anna always says, like the souffle, it deflates very quickly thereafter. The reason I've got the 15-second chart running is it's a terrific chart to use if you're running, if you're trading in relatively congested regions, because it does deliver opportunities. The second reason for using it, it is also a great way to learn VPA very quickly, because if you can move that quick on your feet when you're reading the chart in terms of VPA on a 15-second chart, you'll have absolutely no problem on a 1 minute, 5 minute, 15-minute, hourly, daily, whatever, because the principles are identical. Doesn't matter. It all works in the same way. You can apply it, the methodologies, any chart, any time frame, any instrument. So I've got this running over here, 15 seconds, as I say. Let's just see where we're going. Let's just pop this open. This is the 5 minute, relatively slow in context. We've got a fair amount of congestion going on at the moment. The reason we've got two sort of odd dashed lines here is because the top line, or the level, the line above, if you will, the blue dashed line, is an area of price support, price resistance. It's pretty deep because the width of the line is quite wide, so it's telling us that that is quite a strong area, and it's actually, we've breached it. It was acting as resistance before. It's now acting as a potential support region. But in addition, underneath that, we've got the yellow dashed line of the volume point of control, because the volume is way out here. It's the highest volume on the chart, which is where the volume, the VPOC itself sits. So for the time being, we are trading in congestion. We are trading, to pick up on Anna's point, we are trading at fair value. There is no strong bias one way or the other for the time being on the 5 minute time horizon. And until that breaks away, then we have to be patient and wait. To the downside, we've got a relatively low volume node, although in comparative terms, it's certainly not as low as down here, but it's certainly less volume than we have over here. So that is going to at least cause the market some problems if it's going to move to the downside. And to the upside, we've got some price resistance in here, but as we move to the upside, if we get through 30 or 40, then we really are into some light volume territory from a resistance perspective, and relatively light in terms of price-based resistance. These lines here come off the accumulation distribution indicator, as does this blue one. And what that reveals is it prints those levels, but it also prints them graphically in the context of the extent of that resistance or support by displaying it as a wider band. So every time the indicator is tested, either from above or below, then that level increases in strength. It's a little bit like, I'm trying to think of an analogy, it's a little bit about like a hurricane, I suppose. It gathers strength, it draws in the power that creates it, and that is what is happening here. You see these levels tested. If they're tested again and it holds, then it counts as another block in the wall, if you will, and that level will then thicken accordingly. So this level here, for example, is very lightweight. It's perhaps only been tested once or twice. The little digits over here, you probably can't see them. These regions here, that's a little bit deeper. This is a little bit deeper, and this blue line here is very deep indeed. So it's a very strong area, and as you can see, you've got more down here, a little bit more lightweight in terms of the price action. And in terms of volume, when you have the volume on the y-axis, as you have here, then on the price on the index here, then it really does. It gives you a visual perspective on how much volume is sitting in these regions, and therefore whether volume itself is also going to act as a support or resistance mechanism. And once you get up into these low volume nodes, as price gets here, then you expect the market to move through there pretty quickly. So from a trading perspective, these are great because it just shows you where the volume concentrations are and where price action is likely to pause, and why it has paused indeed, because it will have run into one of these regions. So that's on the 5 minute. Let's just hop up to the 10 minute, 15 minute. There we go. pretty much the same sort of perspective. We're trading around the volume point of control again on the 15-minute time horizon. We had a very strong resistance area here, which was breached, but it's gone back inside. We've gone back down onto the volume point of control again. So everything is just moving sideways for the time being, which is all the more reason to move up to a very fast chart like this. And this may not suit you, but if you want to pick off trades in these sorts of market conditions, you can. But this is the sort of speed of chart you have to work on. As I say, these same principles apply. We've got rising price here. We've got falling volume on the uptrend. What does that tell you? It tells you it's weak. Market's probably going to move to the downside. Now we've got a lot of volume came in, literally, as I'm talking there, a ton of volume under there. Wick to the upper body, heaps of volume coming in, lots of selling pressure. Trend monitors transition through to red for the time being. And the volume point of control, we're now moving firmly away from the volume point of control. That's on 15-second. Fallen away a little bit on that last candle. So the selling pressure's eased a little bit. It's not following through particularly. We haven't seen an increase in volume from this one to this one. We've seen volume fall away. So that's telling us that the actual selling pressure is diminishing. It's not following through strongly to give us a nice price waterfall. It's fallen away a little bit. So we're not expecting that move to go particularly strongly at the moment. Now we'll see what develops on the upside. Not huge. In fact, let me pop that up full size again. There we go. Very low volume on the up candle. Let's see what this one does. Okay, we've got some decent volume under that one. Not too bad. A little bit of a wick to the upper body, but not looking terribly strong for the time being. Let's see if we get some more selling coming in on this candle. Not huge. Average. It's okay. It's sort of in agreement. It's not in disagreement. Trend monitor's bright red, so it's telling us we're bearish at the moment. Sentiment for this index is bearish. A little bit of buying coming in under that one. That's okay. We've got a pivot high here. That's adding some downward pressure. We've got a low volume node, so if we get through this region here, anywhere between 88 and 90, then the market should go through there pretty swiftly. Another pivot come in. But it's not moving that quickly. It's pretty sluggish at the moment, but nevertheless there are opportunities, but it's pretty tight. See what's happening on 5. Lots of indecision in here. We've got a ceiling at 430, so if we're going to go to the upside, we've got to get through that region there. Let's see if we're going to take another run to the downside. Let's have a look at 5. Okay, we've got a lowish volume node here, as I say. Then we've got some deeper volume here, so this is going to cause the market to pause if it gets down to this sort of level, because it's pretty strong there. And down onto the 30, which is our slowest time frame. As you can see, we had the volatility triggered. This was the open here. This was 2:30 our time. Then we get to 3 o'clock. Lots of volatility, ton of volume coming in, and we're now trading inside the spread of the volatility candle, which is what we expect to see. And we either get congestion or we'll get a full-blown reversal. Now we're starting to track down again. Say it's bearish, but it's not heavily bearish. It's not moving at great speed. Decent volume under that one, so there's decent selling pressure. Fallen away again, not followed through. Now we've got some rising volume, so we've got more selling coming in. A little bit of a wick to the underbody there. Nothing particularly to be apprehensive about in terms of holding a short. Let's have a look at the volume under the 5-minute. Okay, it's that's okay. It's in agreement more or less. We've got a benchmark candle here maybe with a wick. Yeah, it's not exactly the same, but the price spread is pretty much the same. So the volume's okay. That looks fine. We're moving lower. That's all fine. Nice short developing now. You know, we're into 10, 15 points maybe. $5 a point, that's not bad. A few minutes work. Could trade multiples. You could scale in or scale out. You may have gone in with 2 or 3 contracts and then start pulling them off one by one, or alternatively scale in and build up a position in the market. Got some buying coming in on this candle. See how the volume is quite high. The price action is compressed. What that's telling me is that there's possible a little bit of buying coming in there. In other words, if this candle is in agreement with that one, then we should have seen this candle as a widespread down candle, something like that one perhaps, maybe even more so, but we didn't. We saw a little bit of buying coming in there. That was reflected in the next 2 candles, so we saw the market rally. We expect it because we anticipated it is here. Now we're starting to see selling coming back in again. We've got rising volume, nice spread candles. That all looks good, fine. Now we're down to 26,370, so we're into 20 points of value. So talking $100 on one contract. And bear in mind, this is in thin markets. You know, this is not moving. This is not a ragingly rampaging market lower. This is sliding lower. And you can see the weakness reflected here on the 30. Tempted to rally, pivot to the upside. We're moving to the downside now on that, and hopefully away from the volume point of control there. Now we're starting to see a little rally higher. Whether it will develop or not, let's see. Let's pop that open again. Volume's okay, it's in agreement. That's fine, that's fine. But it's falling away. Let's see if it'll go. We might go back up to the VPOC again. Same volume on that candle. Narrow spread, not particularly strong. So we had a little rally there. I mean, this is a classic VPA, if you will. You've got narrowing spreads, rising price action, but falling volume, and the market goes lower a little bit. It's just, you know, that is the way it works. It just gives you that information. Now we're coming back on the rally. Decent price spread there. Fine, the volume's fine. Note the trend monitor is starting to transition. We've got a transitional color coming in maybe. That's not going to be reflected on the others yet. We'll see if that follows through or not. Let's go up to the 5 minute. Just going to go over to another workspace. Just want to see what's going on in terms of the other indices, whether they're all probably pretty much trading around the same. There we go. This is I've got the YM daily, I've got the ES daily, and I've got the NQ daily over here. What's interesting is the YM, which is the one we're on, which is this one, looks a little bit weak, tried to rally, it's come off the highs of the session, whereas for the ES, that's come off a little bit, but not as much as the YM, and nor indeed has the NQ. The NQ has held up, and the down candle yesterday was certainly not as dramatic either. So in terms of context, then yes, broadly speaking, the price action is pretty much the same. It's just the extent to which it's moving is not. And I've got 15-minute time frames below for the YM, the ES, and the NQ. NQ, we're trading in a volatility candle, so we had this rapid move higher. Now we're trading back inside, and we're on the volume point of control for that one. Pretty much the same for the 15-minute ES, but we didn't have volatility on this candle, but nevertheless the price actions retraced. And that's another reason for using these 3 indices, running them in parallel, because a signal you'll see in one chart, and this is an example, you've seen it on the NQ, but you've not seen it on the ES. As soon as you see volatility on the NQ, it's giving you a heads up if you're trading the ES. So that may well be the case that we're going to see retracement back inside the spread of the candle because we've got volatility on the NQ chart. And if we go up to the 15-minute for the YM, no volatility there at all. we're just seeing a pretty negative picture. But we've got this very strong platform of support which is being tested right now. If it holds below that, then that is going to add further downwards pressure to the market. Let's just head back to the multiple white spaces. There we go. Now we're trading in pretty heavy congestion here. Now we're waiting for the next breakaway. So we've got the volume point of control. Volume here is the highest. We've got various levels of price resistance, price support layered in here. We've got one here. We've got one more there. That's there. We've got these up the chart. It's just a question of waiting and being patient for the next move. If we get down to 65, then the market should open up and move pretty quickly. And all that's happening in here is price agreement is being reached, and then as sentiment takes hold, one or the other, we start to move away from that region. There we go. Pretty swift, lots of selling volume in there. Nice continuation of the primary trend, the primary bearish trend, which is this one. Doji candle there, decent volume. Not indicative of anything other than indecision. It's not telling you it's going to reverse. It's just saying indecision. Buying and selling is matched. Low volume to the upside. Just searching out some other levels. Let's have a look. What have we got going on here? Let's have a look. Well, we've got a potential support region here down at 50. It's not terribly strong. As you can see, it's not very wide. It's certainly not as wide as this one is. But nevertheless, it's there. So, using multiple time frames to give you a heads up that if we get down there on the 5-minute time frame, then it's looking at a potential support region where the market may pause again. So when you're trading your 15-second chart and you're wondering why something's happened, this will give you the pieces of the jigsaw to tell you why it's happened. Going back to our little up move here, this little candle, very low volume. There's no great inclination to buy the market, and therefore you don't expect that particular rally to last very long because there's no sustained buying coming in. So the selling remains intact. We're still selling decent volumes on the selling. Now we've got a little bit of, we've got a wick to the lower body of that candle. We've got a decent volume underneath there. There is certainly some buying coming in there, but probably not enough to reverse it. Trend monitor is helping to keep us in. Now we're building up some nice points. Where have we come from? 90, we're down almost down to 50, that's 40 points, that's $200. It's all very comfortable, even though, ironically, you're on a fast chart. You're now starting to see transitions in the trend monitor as we move into an inverted commas slower time frame and potential reversal of the trend from what was bullish from the open. Now we're starting to see a change in sentiment. And of course, the other change in sentiment you'd be looking for is over on the in the Forex world. Certainly be keeping a close eye on the yen, see what's going on in terms of yen pairs, whether they're broadly buying or broadly selling. And that will give you a heads up in terms of sentiment for the indices and equity markets in general. Just go onto the tick charts. I think I've got the YM there as well. There we go. So if you don't like trading fast time frame charts, then you can move out onto the tick charts, because the tick charts they can be just as fast. They're time independent, so they will reveal a true momentum in the market, because there is no governor of time here. The only time element is how long it takes to actually build each of these candles, and that is variable according to each candle. So if it's a millisecond or a nanosecond, whatever it is governed by the number of ticks going through the market. So for a 610 tick chart, just change these over to make sure. Let's make that one 1597. There we go. Oh, sorry, wrong one. That's 1597. This is 610. Sorry, beg your pardon. There we go. In terms of the number of ticks going through, once 610 ticks have gone through the market, that candle will complete, and that's completely independent of time, because this is the metric that governs the candle formation. What's interesting up here has just caught my eye up on this is the 1 minute. This is what delivers the actual tick setting. This is the tick speedometer. It actually delivers the optimal settings for your tick chart. You can see here we've got high volume here. We've got narrow spread price action. So we know there's buying coming in. There has to be. We're in a downtrend, mini downtrend. Then we get a ton of volume coming in. We know we're going to see a reaction higher because we've got buying. This is huge volume. The candle's compressed, hasn't gone anywhere. If it was heavy selling, the candle would have been widened down. It isn't. It's narrowing up. That means there's got to be some buying in there. Not enough to change the sentiment, perhaps, but nevertheless enough to reverse markets higher temporarily, which is what it's all about, because it will just calm the nerves of emotion when you're trading. And then when you see something like this with the volume falling away, you just think, okay, fine, I'm quite comfortable with that. I know exactly what's going to happen here. You know, the market is going to pick up reinstate the primary trend of bearish price action, which is what's happening at the moment. Albeit this is very sluggish. These color changes here are really telling you that the market is pretty sluggish right now. These tick numbers are pretty low for this index. At this time of day, they should be a lot higher than this. They're not. So we are trading in a pretty sluggish market. So whenever the red color appears, that's telling you participation is low, and therefore, you know, the price action is likely to be more measured. It's not going to be fast moving until these change back to either green or orange, when you do see a much improved momentum in the market. And that's really what it's about. It's about participation in the market through volume. Let's just go back to our time-based charts. See how we're doing. It's very nice. All nice and calm. Back down to 40 now, so nice points in the bag. Very pleasant. Thank you very much. What's interesting is now we've got volatility again triggered on the 30-minute, and this indicator triggers before the candle has closed. So you can see we've got 1 minute to go to top of the hour, 4 o'clock. This has triggered in real time. As soon as we've moved outside the average true range, we know we're in volatility country, and therefore the expectation is we're now looking for the opportunity or the expectation that the price action may well retrace within the spread of the candle. So if we're trading short and we see this coming in, maybe an opportunity to close out, take our profits off the table, because now what we're looking for is a potential reversal, possibly back up to the VPOC, maybe even higher than that. No guarantee it will, but merely the fact we've got the volatility indicator triggered is sufficient cause to make you think and decide whether you're going to stay in and sit through any congestion phase, or whether it's better to close out, take the money off the table. We've had a good run, and let's just see what develops on the back of the volatility. I haven't got volatility anywhere else at the moment, so it's just on the 30. Okay, that candle's closed off now. There we go. A little bit of buying coming in on that candle. You've got a mini hammer. Wick to the underside. good volume underneath, so we're expected to see the market rally off that. Oh, sorry. Get that out of the way. There we go. A little bit more buying coming in under the next one. That's a son of hammer, if you like. It's a little mini hammer. Decent volume. You know, some more buying. The market's fallen. Buyers come in. Market's risen. Now we've got a pivot to the upside, developing. And really what it comes down to is looking at the time frame of your chosen window of opportunity, if you will, and whether that is enough, sufficient for you to get out, or whether you're going to hold this position because you're looking at it from a longer term perspective. If you're trading off a 15-second or 30-second chart, then you know that is where you sit as a trader. You're an out and out scalping trader. You're going to be doing tens, maybe more than that, number of trades a day. If you're trading this for the longer term, and I'm talking relatively speaking now, you're on a 5-minute time horizon here. What have we got here? We've got falling price and we've got gently rising volume. So that is telling you that the bearish sentiment remains intact for the time being. The trend monitor's red. We've gone through the transitional from bullish. We're straight through into bearish, and we've got gently rising volume, which is confirming the negative price action or the negative sentiment for the time being. And I've also got the Renko running as well down here, which again is a non-time based chart. It smooths out the price action, gets away from the spikiness of the price action, and just presents everything in a momentum based way, away from time based charts. Nothing wrong with time based charts at all. You can see here we've got the volume point of control. It's down here now. We're trading around this region, highest concentration of volume. We've got some pretty extreme, pretty heavy resistance developing overhead here. Got a low volume node below. Volume is building all the time. We've got a low volume node below here. Transitional on the trend monitor over on the slowest time frame, the 15-minute. And whenever you get these congestion phases building around the volume point of control or indeed anywhere else, then it's a question of deciding where your levels are. Where is my comfort level? If you were looking at this, for example, okay, you know, we're trading at 45. We've got some decent levels here. We've got some price levels. We've got volume here. If we're going to break to the downside, where do we get in? Do we wait till we get through 35? Do we wait till we get somewhere deeper? If we're going to get into the upside, you know, where are our levels? Where is our comfort zone of entry that we're comfortable with getting into the market and is far enough away from any congestion to give us that that feeling of comfort that we're jumping in. Right, I'm going to pass back to Anna because we're probably going to have to wrap up very shortly. So let me pass back to Anna, and I think we can take any questions there are, if there are any in the chat box. Sorry, I always have my chat box closed, and we'll wrap up.
Brilliant. What I've done over here is I've not, as I said in our earlier webinar, my ninjas. I need to set all my ninja up again for various reasons. But you can actually trade the indices if you've got an MT4, MT5 account, because all the brokers offer instruments, they offer stocks, they all sorts of things. And this is actually it's a derivative. It's the US 30 cash. It's obviously the Dow Jones, and we can see here we've got Globex. And with obviously the volume, again, we have the volume point of control. This is this yellow line. We've also got the Camarilla levels up at the on this chart, but I'm not going to talk about them on this occasion. And we've had the move away from the VPOC. We've had the move down. This is the open. This is the usual volatility that we had at the open. Then we had the volume coming in. Very strong volume, but look at the volume. The volume came in, but it was falling on all the up candles. In fact, the price went back to the volume point of control, and we see here falling. The volume wasn't that fantastic. Lot of no strong bias in either, in one way or another. Then we do have a break. We see here this this sort of waterfall that we have here. Widespread candles, but again the volume is not, given the width, the size of those candles, you say, well, how come, you look at the up candles and you have much higher volume? You have to see this volume in relation to the open. The open will always have a surge, if you like. So let's take these as more normal, the normal relationship between the candle and the volume, not over the average line. This is kind of a little average line we have here, but we have this waterfall. Now, what was interesting, we had this buying coming in under this candle here. We've got a deep wick to this candle, but it wasn't enough to push it higher, and then we actually had a further fall. Now you say, well, what's actually going on? And this is where you really do have to look at multiple time frames. And on a time-based chart, the 30-minute chart, I personally have found is a great chart, because when the volatility is triggered on the 30-minute chart, you have this very typical reaction of the price retracing to within the spread of the candle. This is the retrace that we are seeing on the 4-minute chart. So by all means, read the signals on the faster charts, but always benchmark them and see what is actually going on a slower time frame. And in fact, we've got, you could say that was sort of stopping volume. There was also the reversal of price purely based on volatility. What happens with volatility, you either do get a reversal or you get more congestion. So interesting price action across platforms on the same instrument. And as I said, it just gives you, and if Ninja Traders is a platform that perhaps you don't want to use, you can't use, you can still trade multi-assets. You can certainly do that on TradingView, and perhaps next time we'll look at TradingView, David, what do you think? Or MT4/5. Right, very quickly, I know there's people who maybe have not come across us before. What am I looking at? Sorry, wrong one. I beg your pardon. There we are. The indicators that we use are from Quantum Trading, and it's quantumtrading.com. I just said. There we are. These are the platforms that we have at the moment. We're actually working on TradeStation as well, and all you need to do is just on the more information on the individual indicators is scroll down to the page. Let's do the VPOC here. Just click on the VPOC, and it will bring up all the videos and the support pages. You can buy the indicators individually. You can buy them. We have bundle prices, or you can buy the full package. The advantage of the full package is that when we develop new indicators, they are automatically added to your package. Everything is covered by our 7-day money-back guarantee and our fantastic customer service. Even if I say so myself, or the guys who run that for us, they are truly available 24/7. Anything else you want to add to that, Brian? No, that's it. We will be back with you next. Oh yes, if you've got the Ninja 4 package, the next indicator that is we added to your package is actually an index for the British pound. So you've got dollar index, euro index, and British pound index. Anything else you want? That's it. Lovely. Enjoy the rest of the trading day. Tomorrow, of course, is NFP, and that should be the usual fun and games. Otherwise, if you're not trading, enjoy the rest of the week, enjoy the weekend, and we are back next week at the same time. Thank you so much for joining us today, and catch you next time.